Sonalia, can you hear me?
Yes,
Sonalia, please start reading the question.
Roscoe expects to receive €750,000 from a credit customer in the European Union in 6 months' time. The spot exchange rate is €2,349 per $1, and the 6-month forward rate is €2,412 per dollar. The following commercial interest rates are available to Roscoe. Deposit rates and borrow rate: euros 4% per year, borrow rates 8% per year, dollars 2% per year deposit rates, and 3.5% per year borrow rate. Roscoe does not have any surplus cash to use in hedging the future euro receipt. It also has no euro payments to make. Roscoe is also considering using derivatives such as futures, options, and swaps to manage currency risk. In addition, Roscoe is concerned about the possibility of future interest rate changes and wants to understand how a yield curve can be interpreted.
Okay, guys, so this is the question. That this is the Rose company. The Rose company expects to receive euros from a credit customer in European Union in 6 months' time. So, examiner is saying to you people the first question: what would Rose company do to reduce the risk of euro value dropping relative to the dollar before the 75,000 is received? Guys, what we should do now? Can anyone who will tell me? Guys, can you tell me?
Enter into enter into forward contract to sell £750 in 6 months.
Okay. Whether can you people tell me that deposit 750,000 euros immediately? Try to understand everyone who is present in the class, guys. See, euro is the foreign currency, and these euros you have to receive after how many months? 6 months. So, as this money you have to receive after 6 months, how you are going to deposit them immediately? You are going to receive them after 6 months. So, this statement is wrong. Enter into an interest rate swap. No, this is a currency question. You have to receive this foreign currency 750,000. So, interest rate you cannot apply. Then enter into a forward contract to sell 750,000 in 6 months. Yes, this is the right answer. That you will go to a bank and you will book a rate at which when you will receive the euros, you will sell the euros. What is the forward contract? The forward contract we will book today with our bank, that when I will receive the money, I will sell at this price and I will convert into my home currency. So this is the right answer. In the B part, what is the dollar value of forward market hedging in 6 months' time? So everyone who is present in the class, guys, please try to understand. The money market hedging is always of the two types. Money market hedging is two types. One is when you apply the money market hedging on the foreign currency receipts, and then you apply on the foreign currency payments. I will tell you all the both of them, and then you will apply. Guys, in the foreign currency receipts, first is you have to calculate the present value of foreign currency using foreign currency borrowing rate. Then you will convert your foreign currency into home currency using spot rate, and then we will invest this home currency. What is the difference between foreign currency receipts and the payments? In the case of the payment, first step is we will compute the present value of foreign currency using foreign currency lending rate. Then convert this foreign currency into home currency using same spot rate. And then here first you are lending. So then in the last step we will borrow this home currency. So guys, all of you, please try and tell me this question is for the foreign currency receipts or for the foreign currency payments, guys. Tell me. What is this? This question which you people are solving. This is for the receipts. You have to receive. So guys, can you people tell me? First of all, examiner has just asked the forward market. So the forward rates has been given. What is the forward rate, guys? 2.412 per dollar. What was the forward rate? 2.412 euro per dollar. So which money you have to receive, guys? Euros? 750,000. So please tell me after conversion what will be the answer? Hurry up. Tell me, guys.
1809000.
In the forward contract, what is happening? This forward rate was given. This forward rate was given us. So this is the euro, which was the foreign currency, and we want our final answer in the dollars. So first of all, my question from you people, many people do not know, sir, whether we will multiply or whether we will divide. So guys, can you tell me that what will happen, whether the foreign currency will be multiplied with the rate or divided with the rate? Tell me, guys.
Divide.
See, guys, this was the euro. When you divide by euro or dollar, euro will cancel and you get the answer in the dollars. So divide and tell me what is the answer coming. It is coming as 310,945.
Yes. We do it because it's a receipt and it needs to be less.
No,
I want
that
to
hold on, Raina. That concept we apply when the two rates have been given. It is only the single rate, the forward rate has been given. Okay. Now, examiner is asking if Rose company used a money market hedge, what would be the percentage for the borrowing rate for the period? Now see, I told you people, what is the first step? Calculate the present value of foreign currency
Using
using
borrowing rate.
foreign currency borrowing rate. Guys, in this question, dollar is your home currency, euro is your foreign currency. So you have to choose the foreign currency borrowing rate, mean the euro. So guys, euro borrowing rate, what was given? This is the euro, this is the borrowing rate. But this borrowing rate is per year. You have to receive in 6 months time, guys. So please tell me what will be that rate? 8 divided by 2. How much? How much, guys?
4.
So this is the answer. 4. Understand? Now, the next question is, which of the following statement is correct? Once purchased, a currency future contract has a range of settlement dates. Guys, tell me whether this statement is true or false. Tell me, guys.
I think false.
Why? Guys, the currency future has only the, not a range. They have only the 4 settlement dates. March, June, September, and December. So they have only few, not a range. Now, currency swap can be used to hedge exchange rate risk over longer periods than forward markets. Yes, guys, that statement is a true. Currency swaps are being used for long-term hedging. So this statement is true, guys. Banks allow forward exchange contracts to lapse. No, guys, this is also wrong. Forward is a contract. You have to fulfill it. It cannot be lapsed. Currency options are paid for when they are exercised. No, guys. In the case of option, what is happening? We always pay the premium cost in advance. It is only giving you a choice. If the option is favorable for you, you will avail it. Otherwise, the option will lapse. But the premium cost is always payable in advance. Now, which of the following statements is correct? The government can keep interest rates low by selling short-dated government bills in the money market. Guys, is this statement is true? Government can keep interest rate low by selling short-dated government bills in the market. Tell me, guys, this is true or false? Anyone who will tell me, guys? You people are saying it is true?
So this is true.
Okay. This is false, guys. See, what will happen? When governments can keep interest rate low by selling short-dated government bills. When the government is selling the short-dated government bills, it's mean that the people will start buying them. When the people are buying them, this will reduce the money supply and it will exert pressure on interest rate increase, not the decrease, guys. So this is a opposite statement that has been stated here. Then the normal yield curve slope upwards reflect the increasing compensation to the investors for being unable to use their cash now. Yes, this statement is correct. What is happening? What is the slope of the normal yield curve? The slope is like this. At one side, you are having the maturity. At one side, you people are having the yield. So if one bond is maturing here, the yield is here. If one bond is maturing here, yield is here. Why? Because if a bond have increased compensation, why the slope is upwards? We are paying to the investor if its bond is maturing after more years. So we are compensating him more. That is it true. The yield curve on long-term loan is lower than the yield term on short-term loan. No, till we discuss this. Expectation theory states that future interest rate expectations of future interest rate movements. Guys, what is the expectation theory? Guys,
That
remember, expectation theory states that future interest rate reflects expectation of future inflation rate. No, expectations theory states that interest rate reflects expectation of future interest rates, not the inflation rates. So this statement is also wrong. Okay. Now, Advent Company. Advent Company is based in country C, where currency is the CS. Advent is expecting the following transaction with supplier and customers who are based in Europe. 1 month. So you have to receive euros. And then in the 1 month, you have to pay euros. So guys, how much will be your net payment or receipt, guys? Can you tell me? Net payment or receipt?
100,000
100,000
receipts.
100,000 euros receipts. And guys, this phenomena, when in the same currency you have the payment and in the same currency you have the receipts, when you are netting off them, this phenomena is known as the matching. Remember it. Now, the 3 months expected euro receipts have been given. This okay. A 1 month forward rate 1.7832 euro per dollar has been offered by the company bank, and the spot rate has been given as 1 point this one. Other relevant information is as follows. The 3 month European borrowing rate has been given, and then the 3 months country C deposit rate has been given. Assume that it is now 1st April. So examiner is asking, what are the expected dollar receipts in a 1 month using a forward hedge? So guys, very easy. This was our receipts. This was the forward. So guys, please tell me what would be the answer. Hurry up. 100,000 euros. This was euro per dollar. So divide by 1.7832. What is the answer coming? How much dollars?
The first
Five
one,
point nine zero.
56,079.
Okay. Now, examiner is asking, what are the dollar expected receipts in 3 months using a money market hedge? So, guys, first of all, answer me. This question is for the payment or the foreign currency receipt, guys. Please tell me. Tell me.
Receipts.
This is the foreign currency receipts. Well done. Now, in the foreign currency receipts, I told you people the first step is you have to calculate the present value of foreign currency using foreign currency borrowing rate. So, guys, first of all, in this question, what is the foreign currency? Euros, home currency, dollars. Now, first of all, we said that we are going to have the present value of foreign currency using foreign currency borrowing rate. So, guys, what was that amount?
1.35.
100,000. Now, what was the euro borrowing rate, guys? This is A. But anyone here who will tell me this was the 3 months European borrowing rate? Hold on, guys. Hold on. He was asking for 1 month or okay. See, he was asking what are the expected dollar receipts in 3 months using a money market hedge. So we have to pick the 3 months figure, guys. That was 300,000 euros because 100,000 was for the 1 month. So 300,000 euros divide by anyone who can tell me which rate we will choose, guys. Hurry up.
The 1.35%.
1.25
25.
or 25? Where the 25 is given?
1.35%.
Again, think, guys. Again, please, everyone. Which rate we will choose, guys? Please speak, guys. I cannot, every time I cannot say, see your chat. So please try to speak in the class.
Aren't we going to divide by the full 1.35 because it says 3 months euro borrowing rate?
Okay. So you people are saying, sir,
Divide by 1.5.
which you are saying, Nimra?
101.35.
Okay. You are saying we should use 1 point.
101.35.
Okay. What is the amount coming?
26296,004.
26
296,004. No, sir, 296,004.
Again tell. 26.
29, sir, 296,004.
It is starting from 29.
Okay, 296,004.
This one.
Okay,
And this is which currency?
euro.
Now the second step was convert this euros into the dollars using the spot rate given. So what was the spot rate which was given? So euro 296,004 divide by 1.7822 euro per dollar. So what is the answer coming in the dollars, guys?
166089.
166089. Now the last step was, as first we are borrowing, now invest it. So 166089 multiply by how much? 1.115. Tell me, guys.
Yes, sir.
So what is the answer coming?
One 85189.
18. This is not the answer here, guys. Where we are mistaken. Please identify the mistake. Everyone.
At step two, where you divide. Where
Six
you're
seven
supposed to
triple
multiply.
nine.
This one?
Step two, where you divide. Where you're supposed to multiply.
No, why we are multiplying? This is
167.
euro per dollar. This is euros per dollar. So our currency was coming in the euro. See, again in the question, try to understand. Edwin based in a country C where currency is the CS. So this C dollar is our home currency. And Edwin is expecting the following transactions with suppliers and customers who are based in the Europe. So this euro is a foreign currency for us. So then examiner said that the 3 months expected receipts are there. That is 300,000 euros. So as we know that first, it is a foreign currency receipt question. So for the receipts, first step is we calculate the present value of foreign currency receipt using the foreign currency borrowing rate. So as you people are having the 3 months, so the 3 months rate was given, that was 1.35. So again, let's perform the calculation.
आंसर आ रहा है 167,999.
Hold on. 300,000 and 1.35 over 100. See guys, this is the mistake, I think so. See now, 1.35, 300,000 divided by 1 plus 1.35 divided by 100, it is giving you 0.0135.
135.
So when you will add both of the figures, 1 plus 0.0 135. It is giving you 1.0135, not 10. Nimra, what is this giving you? 1.0135. Now tell me, guys, what is the figures coming now? See, a small mistake can ruin all the question.
296003.
296003.
Hmm.
Please,
The same
everyone.
answer as previous.
Round the four, huh? 296004.
So now convert. How much is the dollar?
166089.
Then 0.0115. How much is the answer?
1167999.
167,999.
Yes.
Any answer here, guys? Okay. Now, Advent Company is expecting a fall in the value of dollars. What will be impact of fall in currency exchange rate? Exports will be given a stimulus. The rate of domestic inflation will rise. Now see, guys, first of all, everyone who is present in the class, first of all, you have to understand a small topic. And what is that? The currency appreciation or depreciation. Guys, remember, whenever your home currency depreciates or home currency appreciates, like if I say to you people, the today rate is 200 rupees per dollar, and after some time, the rate between rupees and dollar is going to be 250 rupees per dollar. So remember, guys, as today, to buy $1, I am spending 200 rupees. And to buy the same $1, I am going to spend 250 rupees. It's mean that rupees is depreciating, dollar is appreciating. Now, guys, whenever your home currency depreciates, it is always a gain for exporter. And when your home currency appreciate, it is a loss for exporter. And on the other side, if we will talk about the again depreciate or appreciate. Guys, as I said, gain for exporter. So if home currency is depreciating, guys, this is the export case. This is, let's say, import case. So in the case of imports, it will be a, how much, guys? It will be gain or loss? Tell.
Loss.
Like, this is the example. For example, I have to pay someone $1,000. If I will pay today, how much rupees I have to spend, guys? This is the $1,000. This is rupees per dollar. So multiply 1,000 multiply by 2,000. How much I will spend today? How much? $1,000 multiply by 200 rupees per dollar. Dollar cancel. How much? This one. This I will spend today. I will pay. Now, if my currency is like the rate is going to be worse, then what will be the? This is not the actual figure, guys. Please tell me the actual figure. Sonalia, what is the actual figure coming? 1,000 multiplied by 200.
200,000.
Yeah, 200,000.
What about here? Here it will be 250,000. So, guys, when my home currency is depreciating and I have to pay, so it is a loss for me because
Loss.
I have to pay higher, the 50,000 rupees. So loss for exporter. Sorry, importer. Not exporter, importer payment. And if it is appreciating, gain for import. So now let's apply that criteria. What the examiner was saying, guys. The first statement which the examiner was saying. Examiner is saying Edwin expecting to fall in the value of CS. Remember now, the CS dollar is your home currency. Euro is the foreign currency. Am I saying right, guys? So
Yes.
what we are saying that fall in the value of CS. It's mean that our home currency is depreciating and the foreign currency is appreciating. So exports will be given a stimulus. Guys, this statement is true or false, guys?
सर ये थोड़ा सा स्टिमुलस के बारे में बता दें, ये क्या है सर?
Stimulus means the boost.
Yes, it's true.
Tell me, guys.
So this
It's true. It's true.
It is true, guys. We just said whenever your home currency will depreciate, you will face a gain on your exports. So this statement is true, guys. This statement is true. The correct answer is true. The rate of domestic inflation will rise. Yes, guys. Whenever your currency depreciates, the inflation levels are high in that country. Like those students who are from the Pakistan. You know that our currency against the dollar is very much depreciated nowadays, and the inflation rates, interest rates are high. So the both statements 1 and 2 both are correct. Okay.
Okay.
Now Edwin is considering a currency future contract. Which of the following statements about the currency futures are true? The contracts can be tailor-made? No, guys. No, no. Okay, let me give you people more clarity on this. Guys, whenever in your exam, you people are talking about these futures forward, examiner is always ask you people the difference between over the counter and exchange traded derivatives. These are the types of the derivatives. Guys, over the counter contracts example is forwards, forward rate agreements, swaps, and the options. Whereas exchange traded example is futures or the options. The options can be exchange traded as well as over the counter as well. Now, over the counter contracts, they are tailor made, guys. Exchange traded, they are always standardized contracts. They are available in any currency. They are available in only major currencies. Here, no exchange involved, no clearing house involved. Here, clearing house is involved, exchange house is involved. Here, you compute gain or loss on maturity. Here, gain or loss on daily basis. Understand, guys? And here, no initial margin required. Here, initial margin required. Understand, everyone?
Yes.
Now, let's try to solve now what the examiner is saying. The contracts can be tailored. Guys, is this statement true? Tell me. They are not tailor-made.
No.
They are standardized. The exact date of receipts or payments of the currency does not have to be known. No, guys, we know that whenever the payment or the receipt will be there. This statement, tell me, guys, true or false?
False.
Then transaction costs are generally higher than other hedging methods. That is also. Can you people tell me? Future hedging transaction cost is generally lower, not higher than other hedging techniques. The exact date of receipts or payments of currency does not have to be known. No, guys, that statement, when the examiner is saying, why we are saying, guys, does not have to be known. It is a true statement. What is the reason for that? We will not close out the future contract until we receive or we have to pay our foreign currency. Until you have not paid, this contract will stay open. When we will pay, then it will be closed. Because future is a binding contract. If you have opened it, you have to close it. But you will only close it when you will receive or you have to pay the foreign currency. So only the second statement is true, guys. Now, do the following features apply to forward
सर
contracts?
वो
Yes.
सर जो आपने अभी वो नोट्स बताए हैं ना वो ओवर द काउंटर और स्टैंडर्डाइज का, सर वो जरा पेज खोलिएगा.
Your recordings, brother, you will get. Don't worry. Okay. I will share this recorded lecture. And please
ओके सर.
try to speak in the English because most of the people are the foreigners. Okay.
ओके सर.
Okay. Do the following features apply to forward contracts or currency future? Contract price is any currency offered by the bank. Then traded over the counter. Does the following features apply to forward contracts or currency future, guys? We have to tell the examiner. Over the counter, guys, I just told you people, it is a future or forward? Please tell.
Forward.
See now, contract price is any currency offered by the bank and both features related to forward contract. So guys, tell me which statement is true. Both features related to forward, both relates to currency futures. Feature 1 relates to forward, feature 2 to currency futures, feature 2 relates to forward, and feature 1 relates to currency future. Tell me, guys, which one is correct out of these four? I just told you people, the
You.
over-the-counter
It's A.
contracts are, no, what I told you people, guys, see, again, I am opening that. They are available in any currency. Okay. They are tailor-made. The same thing examiner is asking. What the examiner is saying, guys? Examiner is saying they are contract prices any currency. So which feature is this? Over the counter. Traded over the counter. Yes, they both are the forward examples, guys. So which statement is true? Both
The first
features
one.
related to forward contracts. Understand? Now the next question. Zigto company. Are you ready, guys, to solve this one? Are you understanding, everyone? Hello?
Yes, sir.
Guys,
Yes, sir.
are you understanding?
Yes, sir.
Yes, sir.
Now, Z company is a medium-sized company whose ordinary shares are all owned by the members of the family. The domestic currency is the dollar. So remember, what is the home currency, guys?
डॉलर.
It has recently begun exporting to European country and expects to receive 500,000 euros in 6 months' time. So the foreign currency is the euro. The company plans to take action to hedge the exchange rate risk arising from its European exports. Z company cash could put cash on deposit in the European country at an annual interest rate of 3% per year and borrow at 5% per year. So this is the foreign currency borrowing and lending rate has been given. The company could put cash in deposit its home currency at an annual rate of 4% per year and borrow at 6% per year. So this is the home currency lending and borrowing rate. Inflation in the European country is 3% per year, while inflation in the home country of Zicto is 4.5% per year. Examiner has given you
Yes, sir.
the current spot rate, 6-month forward rate, and the 1-year forward rate has been given. Which company wants to hedge its future euro receipts? Which company is also trying to build an understanding of any other types of currency risk and the potential impact of possible future interest rates and inflation rates. Okay. What is the dollar value of forward exchange contract in 6 months' time? Dollar value, and you have to apply the forward contract, guys. Very easy. What was your 500,000? 6 months' time. This is the 6-month forward rate that has been given. So apply it, guys. This is euro per dollar. So 500,000 divided by 1.990. How much is the answer?
51256.
Now,
Can
what is the,
question? Can you tell uh I'm not sure when to divide or when to multiply.
this is easy. See,
Okay.
this is euro. Now the rate has been given to you in euro per dollar. Okay. Now try to understand, if this is euro and you will multiply by euro over dollar, you are getting the answer in euro square over dollar. Raina, tell me, was this required?
No.
So it means that here multiplication is not applicable. So what is the application? The other rule, divide. Euro will cancel and you will get your desired answer in the dollars. Okay.
Okay.
Now, what is the dollar value of money market hedging in 6 months' time? See, again, the whole money market hedging we have to apply. So guys, who will be applying now? Please tell me. First of all, this is a foreign currency receipt or payment, guys. Please tell.
Receipts.
Receipts. Well done. Then,
Present value of foreign currency through borrowing rate.
okay. So guys, what is the euro borrowing rate? 5%? But this is the per year. You are going to receive in 6 months' time. So you will tell the examiner euro 500,000 divide by 1 plus 5, or you can say 0.05 divided by 2. How much is the answer coming? How much, guys? Hurry up. Is this coming as 487,805?
487. Yes, 805.
487,805.
805.
805.
Now the next step was you have to convert these euros into home currency using the spot. This was the spot rate given. So divide this by 2 euro per dollar. How much you are getting in the dollars, guys? 243,903.
Yes.
Yes.
Now the last one was in the West. But which rate we will use? Home currency. So the home currency dollar, this was 4%. But again, that was the annual. 243,903 into 1 plus this was 4, 0.04 divided by 2. How much you are getting, guys? How much? 248780.
43708. E.
This is answer. This you will type here. What you will type here, guys? 248781. Understand? Any issue, guys? Clear? Any issue to anyone, guys? Please ask. Please raise your hands.
Sir, you
Sonalia.
take
Yes, Sarmat.
I understand.
6-month rate.
Brother, 6 months rate we have to take. Examiner has given you the annual,
Sir,
the
you
per
take
year.
6-month borrowing rate.
Yes, yes. Because we are going to receive
Okay.
in 6 months' time. Okay.
Okay, sir.
Now, guys, what is the 1 year expected future spot rate by purchasing par parity? So again, I am going to elaborate this, guys. Guys, you have the two parities which are mostly applied in your course. One is the purchase par parity and one is the interest rate parity, IRP. Purchase par parity gives you people the future spot rate. The interest rate parity provides you people the forward rate. In the purchase par parity, we will use the inflation. In the interest rate parity, we will use the interest. Let us suppose, guys, the current spot rate has been given to you to 70 rupees per dollar. And examiner is saying to you the inflation per year for rupees is 8% and for the dollar is 5%. So examiner is saying to you, compute the future spot rate. Anyone in the class who can tell me what is the formula for the calculation of future spot rate? Please. Tell me, guys. No one knows? Okay, I am here. Spot rate calculation formula is you will take the current spot rate into 1 plus inflation of first currency divided by 1 plus inflation of second currency. So now the point is, sir, what is the first currency and what is the second currency? Guys, the currency which is in the numerator, that is always the first currency. The currency which is in the denominator, that will be the second currency. So guys, which inflation we will take in the, can you tell me now? This is 270. What was the first currency? Rupees inflation. 8%. 1 plus 0.05. So please tell me what will be the future spot rate. Hurry up. What it will be, guys? 278. Well done. Now the same methodology you people are going to apply here, guys. Now you will solve. Examiner is asking future spot rate by purchasing par parity. I want the answer from you guys. This is the spot rate given. So apply this. 2 into 1 plus inflation of first currency. Guys, what is the first currency? euro or dollar? Sonalia, tell me. Euro or dollar is the first currency? Please tell me.
Euro.
Euro. Well done, guys. Well done. So, what is the euro inflation? 3%?
Yes, sir.
3%, guys. Am I saying right? But this
Yes.
is per year. Again, examiner confusing you. It is 0.03 divided by 2. And then 1 plus other inflation was 4.5. But again, see, guys, should we divide by the 2 or not? No, guys, the examiner is asking the 1 year spot rate. See now. Understand? The examiner can ask the 6 months as well. Then we can divide by the 2. But for the timing, no need to divide, guys. So just 1 plus 0.03 divided by 1 plus
0.045. 4.
So what will be the answer, guys? Please tell me.
1.97.
Well done. Easy, guys.
Yes, sir.
Now, are the following statements all true? Purchasing power parity tends to hold true in the short term. Tell me, guys.
I think true.
This is false, guys. Purchasing power parity do not hold true in the short term. It is always true in the long term, guys. Not in the short term. Remember it. It is false. Then expected future spot rates are based on relative inflation rate between two countries. Yes, we just did. We computed the spot rate and we use the inflation rates of the two countries. Tell me, guys.
Yes, sir.
Yes.
We did, Raina. What we did? We said that this is inflation of first currency, inflation of second currency. The same examiner is asking. What the examiner is asking, expected future spot rate are based on relative inflation rate between two countries. This is true. And forward rate are based on relative interest rates. I told you people about the interest rate parity.
Yes, sir.
That is also true. Now, are the following statements true or false? Transaction risk affects cash flow. Yes, guys, that is true. What is the transaction risk? Like, I have to receive $5,000. Today rate is 100 rupees per dollar and rate may be going to change. It's going to be 90 rupees per dollar. It may be 105 rupees per dollar. So guys, what will be the rupees in each? Tell me answers, please hurry up. 500 into this one, this will be giving you this one. Then 90 into 500. How much? 90 into 500, guys.
45,000.
45,000. And then it says 105 multiplied by 5,000.
5 to 5,
5.
5 to 500. 2, 500.
This one.
Yes.
This is 5,000, not 500, guys. Okay.
सर 000 में.
So see,
Yeah.
this is the transaction risk affects the cash flows. Yes, our cash flows are being affected. What is the transaction risk? That my currency, my exchange rates are going in the adverse way. From 100, if it is going to be 90, I will receive a lower amount. So this is just true. Now, transaction risk directly affects shareholder wealth. Guys, tell me.
True.
True, sir.
True.
Guys, it does not affect it directly. Indirectly, you can say. The shareholder wealth is made up with the two things. Once they want the dividend or they want increase in their share price. The hedging do not have it directly linked with this dividend or the share price increase. Okay. So what about the statement 3, guys? Diversification of suppliers and customer base across different countries reduce economic risk. Can you people tell me? This is also true, guys. This is false. This is true. Supplier and customer, if you have in different countries, what is the economic risk? Can anyone in the class who can explain me, sir, this is the economic risk? Please tell.
There's simply economic risks on imports and exports both and long term.
Understand everyone. Guys, economic risk is a long-term risk. Other risk, this transaction risk or the translation risk, they are the short-term risk. The short-term risk you can reduce, you can hedge them by using the forwards, futures, options. The long-term risk, economic risk, it cannot be hedged by these hedging methods. It is only you can hedge when you are shifting your suppliers, when you are shifting your customer base, when you are having your production processes in that country where you can manufacture your products cheaply, then you can compete with your competitors. So this statement is also true. Now, the other question, the Marigold company. Let me see how much are left, guys. Marigold, then Peony company. Okay. Okay, the two questions more. So are you with me, guys? Do you want to solve these questions as well?
Yes, sir.
Are you understanding, guys? Tell me. The session
Yes.
is the session is
Yes.
useful, guys. Okay, giving you people the 10 minutes break, guys. We resume after 10 minutes. Okay. Let me have some rest as well. 5 minutes or 10 minutes break. The question is the Peony company. P company finance director is concerned about the effect of future interest rates on the company and has been looking at the yield curve. Peony, whose domestic currency is dollar, plans to take out 100 million loan in 3 months' time for a period of 9 months. The company is concerned that interest rate might rise before the loan is taken out, and the bank has offered 3 versus 12 forward rate agreement at 7.10 or 6.85. The loan will be converted into pesos and invested in a 9-month project which is expected to generate income of 580 million pesos with 200 million pesos being paid in 6 months time from today and 380 million pesos being paid in 12 months time from today. The current spot rate is 5 pesos per dollar. The following information on a current short-term interest rate is available. The dollar and the peso rate has been given. As a result of general uncertainty over interest rate, Peony Company is considering a variety of ways in which to manage interest rate risk, including the use of derivatives. In relation to yield curve, which of the following statement is true? Expectation theory suggests that the deferred consumption requires increased compensation as maturity increases. Guys, please tell me if this answer is correct or not. Tell me, guys, is this correct or wrong?
I think wrong.
Anyone else, guys? Hold on, guys. Hold on. Expectation theory suggests that deferred consumption requires increased compensation as maturity increases. This is wrong. The deferred consumption required decreased compensation, not the increased one. An inverted yield curve can be caused by government action to increase its long-term borrowing. No, when there's inverted yield curve, so the government action is to decrease borrowing, guys, not increase. A kink discounting in the normal yield curve can be due to different yields in different market segments. Yes, this is true. This is the segmentation theory, market segment theory. At different segments, they require different returns. This is the true state. Now, this was a very important. If the interest rate on the loan is 6.5% when it is taken out, what is the nature of the compensatory payment under the forward rate agreement? Now, first of all, everyone try to understand what do you mean by the forward rate agreement? This forward rate agreement is applicable on your interest payments as well as for the interest receipts. In the case of the payments, choose the higher FRA. In the case of the receipts, choose lower FRA given in the question. Now, for example, you people have booked the FRA at 5%. Now, let's create a scenario. This is our forward rate agreement. What happened in the market? The market is trading at 8%, and then the market is trading at 4%. Guys, when the market is trading at 8%, you have already locked your position at 5%. So guys, when the market is higher and you are paying at 5%, this is a gain for you or the loss? Tell me. Tell me, guys. When the market is trading at 8% and you people are paying 5%, this is a gain.
Yes, sir.
And when the market is at the lower, this is a loss. So guys, when there's a gain, so this gain we will receive from bank. And when there's a loss, we will pay to the bank. And when interest rate recedes, let us say we have booked FRA at 3%. Now the market is at, for example, 2% or 5%. Now this is the receipts. I have locked my position at 3%. That I will receive the minimum interest 3%. Market is paying lower, guys. So now when I will exercise, it is a gain for me. Tell me, guys. And when
Yes.
market is paying us higher, but we have already choose this one. This is a loss. So now let us apply this scenario here. What is happening, guys, here? Examiner is telling you people that what is going to happen, that examiner is telling you that the FRA you people will book at which rate, guys? Can you tell me? As this is a borrower, so I said a higher rate, 7.10, and the actual market is trading at which rate, guys? 6.5. So guys, can you tell me what will be the answer? You have booked the FRA at 7.5%, and this was the FRA, and the market is trading at 6.5. First of all, guys, tell me, this is a gain or loss? Tell me,
Gain.
how this is a gain? You have locked your position at 7.5. They say borrower interest payments. You have locked your position at 7.5. The market is trading downwards, but you have already said you will be paying 7.5. So this is a loss.
Loss.
So if
Okay.
this is a loss, what will happen, guys? We will pay to the bank. So Peony company will pay. Subsequent Peony will pay. So this is the Peony company pays. But how much he will pay? Take the difference. 7.5 minus 6.5. How much? 7.5 or 7.1, guys? Oh, 7.10. Sorry. It is 7.10. So how much is the difference, guys?
0.6.
0.6. Now,
If we pay toward bank, then what is the advantages of FRA?
brother, FRA is only giving you the advantage when the interest rates are moving upwards in the market. Like if the interest rate was in the market 8%, then you will be paying 7%. Then it will be beneficial for you. But the interest may increase or decrease as well. So if the interest is decreasing, it is a loss for you. Okay. So 0.60. multiply by loan. How much was the loan, guys? 100 million. And the loan period was 9 months. Okay, easy. So compute it, guys. It will be 100 million into 9 over 12. How much is the balance, guys? How much we will pay?
450.
So P company
450.
pays bank 450. This is the answer. Now, using exchange rate based on interest rate parity, what is the dollar income received from the project? Dollar income received from the project. See now, this was the information which was given in this question. Examiner told you that in 6 months' time, how much we are going to have? 200 million pesos in 6 months' time. And 380 million pesos in 12 months' time. So what are the cash flows, guys? Can you tell me? Cash flows? 6 months? 12 months? 6 months, how much? 200? And 12 months, how much? 380? Now, examiner is saying apply the interest rate parity. What was the interest rate parity formula? You will compute current spot rate into 1 plus interest of first currency divided by 1 plus interest of second currency.
Second current.
So what was the current spot rate which was given, guys? Can you tell me? 5 pesos per dollar. So peso is the first currency, dollar is the
Yes, sir.
second currency. So their interest rates have been given. Okay. So please tell me, guys, how you will compute now. 1 point. This is the per year. So first we have to compute for the 6 month, guys. So can you tell me what will be that figures? 5 was given. Then 1 plus interest of first currency. The first currency interest was given how much, guys? 10%. So that will be 0.05 divided by how much? 1 plus second currency rate was given 6 point something. 0.0325. So tell me, what is this rate coming, guys? Hurry up.
5.0.
The net figure after multiplying 5.0847. Tell me.
Yes. Yes.
This was for 6 months. If you have to compute for the 1 year, so the 1 year rates have also been given. Just apply that rates. This was 5. Pesos is 1.10 over 1.065.
0.065.
What is the 12 months rate coming, guys?
5.16.
5.16. So just these are the rates now. Apply them. Here the rate is 5.0847 and the other rate was, which we computed,
5.16.
5.16. And the rate are in which currency? What were the currency denominations, guys?
dollar,
Pesos per dollar.
pesos,
Pesos per dollar.
dollar.
So these are the pesos. So divide them and tell me the answer. 200 divided by 5.0847.
39.33.
39.33. Then how much?
3.64.
70.
3.64.
Add them both. What is the answer?
112.9.
This is the answer. Now, examiner is asking, in respect of P company managing interest rate risk, which of the following statement is or are correct? Smoothing is an interest rate risk hedging technique which involves maintaining a balance between fixed and floating rate interest. Yes, guys, that is a true statement. Smoothing is a technique in which instead of having one nature loan, you are having the fixed and floating both nature loans. Assets and liabilities management can hedge interest rate risk by matching the maturity of assets and liabilities. Yes, that is also correct. So both 1 and 2, they are correct. Now, in relation to the use of derivatives of P company, which of the following statement is correct? Interest rate option must be exercised on their expiry if they have been not exercised before. No, guys, options are not mandatory. If the options are favorable, only then we will exercise. Otherwise, the option will lapse. So the first statement is incorrect. So Peony can hedge interest rate risk on borrowing by selling interest rate futures now and buying back. Yes, that statement is true. I am going to tell you this. This statement is true. Now see, guys, I am giving you people a small know-how. Many students, they are confused. Sir, we do not know that when to buy future, when to sell future, and guys, sir, when to buy cap, when to buy floor. So should I give you people the brief explanations, Gav? Please tell me.
Yes.
Yes.
Now see, guys, in the case of interest rate topic, if we have to talk about futures, if you people are solving a borrower question or you people are solving a lender question, if you people are solving a borrower question, so it will be always sell future now and then buy future later. If you are solving a lender question, so then buy now, sell later. Understand? If you are talking about options on interest rate futures, if you are talking about borrower or lender, in the case of borrower, as we are saying sell future, so it will be a put option, guys. If we are saying lender buy future, So it will be a call option. Now, if we talk about cap, floor, collars, and the collars two types, borrower or the lender. Cap is for the borrower, remember. Floor is for the lender. The collar is a mixture of cap plus floor. In the borrower collar, we buy cap, sell floor. In the lender collar, we buy floor, sell cap. Cap is for maximum interest payments. Floor is for minimum interest receipts. This is a very, very useful information for all of you. See you people tomorrow or the day when I will announce. So we will revise the areas, whatever you people will say. Try to put your best efforts in the remaining days. Try to be active in the group. To see you people by the next class. Thank you so much. Take care. Good night.
Thank you, sir.
Please pass on your valuable
Thank you,
feedback.
sir.
Thank you, sir.
Pass on your valuable feedback in the group. Sarmat, Asad, Aisha, Nimra, Nitya, Rudat, those students who are not even my paid students, please, it's a request by me. Thank you so much, guys, for joining the session. It was really a very, very nice session with you guys. I hope, wish you all good luck. Thank you. Take care.